driven. Let's bring in our floor show traders on this Monday, Tom Hayes and Scott Redler. Tom Hayes, we really have had quite a roller coaster, but there comes a point where with about 12, 13 days before Christmas, depending on how late you go to shop, you've got to tell us exactly how, as a trader, you are positioning your portfolio.
Yeah, well, what we're seeing, Liz, as you had mentioned, cyclicals and the reopening trade are down today. Defensives like pharma and staples are up. So we like a couple defensive stocks. We like Bristol Myers here, and we like Becton Dickinson here. Bristol Myers is trading at 7.5 times next year's earnings. That compares to its historic multiple over the last decade of 16 times. Part of that is just because of the fear of the drug pricing rules in the Build Back Better program. We think a lot of that news is priced in, and we don't think that the restrictions will be as bad as anticipated. And Becton Dickinson is going to grow at 10% earnings next year. It's trading below the market multiple at 18.4 times, and you get a 1.42% dividend yield while you wait.
Yeah, while you wait. But here's the thing, Scott Redler, as we are waiting, we have to hold on very tightly, because days like this where we look and say, OK, the Dow's down 212. It's not a huge percentage drop, just about 0.5%. But you string a couple of those days together and you've got to pivot yourself to look at this as a buying opportunity at a time where the market has been nearly a straight up move. So first start with the sort of 30,000-foot picture, if you would. We have consumer discretionary that's under a bit of pressure here. But as Tom mentioned, pharma's doing pretty decently, and some of the other names. Where are you looking when you look at your actual charts? Because you're not a big fundamentals guy.
Well, every week we've been approaching the charts very carefully because, as you mentioned, the rotation has been pretty violent. And although the S&P is 1% to 2% off all-time highs in a straight line, as a lot of people say, you have a big percentage of stocks that are 70, 80, almost 90% off their highs. If you look at Kathy Wood's portfolio, most of those high growth names have pretty much been in downtrend since February.
Yes.
So as a trader, you have to be careful. You know, even like with something like Apple, you mentioned Apple's near $3 trillion. Everybody's looking at it. For most of this year, Apple was in consolidation, so active traders weren't looking at it. So basically in November, it finally ignited over that 150, 170 area, and now it's approaching that $3 trillion. But if you're an active trader who hasn't been involved, and all of a sudden you're like, oh, I missed it, I want to buy it today, it might not be the right time. So are you a market timer? What's your time frame? If you're an investor, 1,400% in Apple over the last decade, congratulations. I have a feeling it'll probably do very well the next decade. May not do that, so you stay with it. As far as the Fed, though, Liz, like you said on Wednesday, a lot of people are saying they're going to reduce the QE asset purchases by $15 billion. Some think that $30 billion is priced in. I don't. If all of a sudden on Wednesday they say, hey, they're going to reduce the pace of purchase by $30 billion instead of 15 and accelerate the process, that's when traders are going to have to really watch their levels in the S&P and make sure we don't get a bigger pullback than the 1-2% that we're seeing in the last day or so.
Tom, I think Scott is very much right. But again, we do have the Federal Reserve bearing down on us. Two-day meeting starts tomorrow. We'll know Wednesday how they view the world. Right now, we've got the 10-year yield at 1.426%. This, I believe, is holding below 1.44% for the third day straight. Tell me what you see when it comes to exactly where we might look at an opportunity between Christmas and New Year's.
Yeah, I think the opportunity between Christmas and New Year's historically has been to buy the beaten down laggard stocks that underperformed this year to set up for next year. And I think the Fed is going to go out of their way with Omicron and everything else to separate rate hikes from taper. So while they accelerate the taper, it ends in March, I think they're going to be very clear. It doesn't mean that we're going to be raising rates immediately. We have to see what the data shows in March or April. As such, we could see a bid from some of the cyclicals in reopening that are down today, some of the bank stocks, some of the energy stocks, et cetera.
Yeah, energy pulling back just a bit today. Tom, Scott, great to have you. Thank you very much. We have some breaking news we need to get to you. The Department of